Lisa says take out the investment in property, plant, and equipment. So we go here, and let's go back to the balance sheet. We don't have a cash flow statement, but we do have a balance sheet. And we see we have net fixed assets here and here. So if we take ending net fixed assets minus beginning net fixed assets, and then add depreciation expense here. Sorry we're having to turn around so much. So depreciation expense is 9.7 million. So let's flip back over. And so this is, I don't know if you can read this number, but 97,031,250. This is ending net fixed assets minus beginning net fixed assets plus depreciation expense. Okay? And they spent 36 million. So here's our NOPAT minus our free cash flow. Minus our investment, and we get our free cash flow. So free cash flow in 2004 was $20,870,150. Take that and multiply it by 1.2, 20% the first year, and 10% in the second year. Okay? And then 6% in the third year, but we're going to sell it right here. Okay? All right, so here are our cash flows. This is what's going to determine the value of the firm, our cash flows. So we're going to get this plus this, and then we'll sell it here. And we need D1 out here if we're going to sell it in 2006. Sell it in the last year of fast growth. Okay, that is the supernormal to constant growth formula. Okay, find the present value of the cash flows, and the cash flows are free cash flow plus your terminal value. Your terminal value happens in the last year of fast growth, which is 2006. All right, now, so we've got our cash flows. Now we have to find our discount rate. So our discount rate is going to be our weighted average cost of capital. Okay, so our debt, and since it's a private company, to find the weight of debt and equity, we're going to look at strictly at the book value on the financial statements. So we go back to the balance sheet, and we find in 2005 that their owner's equity is 95 million, okay, and their so their total assets and liabilities, their total owner's equity and liabilities, 162 million. 95 million of that is owner's equity, and 66 million of it is, well, if it depends on whether we want to use long-term debt or current liabilities. 53,375,000 divided by 161,718 is roughly 34%. So, not 36%. So 36% of their capital is debt, and that means 64%, which is owner's equity, 95 million divided into the 162 million, sorry. Now, 64% is equity, 36% is debt. Now we have to find the cost of each. Let's find the cost of debt first. And that's easy because it says on the balance sheet that long-term debt is 14% per year, pre-tax. So they tell us that, pre-tax. So if we multiply, we have to find the after-tax cost of debt. So we take the 14% and multiply the 14% by 1 minus the tax rate. So B14 is 14% right there, by 1 minus the tax rate, and we get 8.4%. So that's the after-tax cost of debt. Now we have to find the after-tax cost, the cost of equity. And Lisa wants us to use the CAPM. Okay? So, the beta is the average, so the CAPM is the risk-free rate plus the beta, and the risk-free rate, let's see where our risk-free rate is. Hold on a second, let me look at that real quick. I think it is on the last page. Lisa tells us. Lisa tells us on page 55. Lisa says the risk-free rate is 4%. Okay, so the risk-free rate, CAPM, is 0.04 plus the average of the betas for the industry. So if you take the beta of 1.2, 1.3, and 1.15 and divide by 3, you get an average beta of 1.22. Okay? So here's the formula. You have 0.04 plus the beta of 1.22 times the expected return of the market. Well, actually, that should be 8%, not minus 4%, because it says the market risk premium is 8%. So let's go ahead and just make this adjustment right now. The risk premium is the expected return of the market minus the risk-free rate. But so we're actually by subtracting the risk-free rate of 4%, we're double counting the cost. We're double counting the risk-free rate, and we don't need to do that. So we're going to go ahead and take that out, and our cost, so our cost of equity using the beta and 4% and the risk premium of 8%, we come up with a cost of equity of 13.76%. We multiply that times the equity, the weight of the equity of 64%, and we come up with the weighted cost of equity. We multiply the after-tax cost of debt times the percentage of debt, and we come up with the weighted cost of debt, 3%. So we add these two together, and we get our WACC of 11%. Okay? So, we're almost finished with this, and I know this is very detailed. We take our free cash flow estimate next year and the year after, and we find the present value of it by dividing it by 1 plus the WACC. This is 1 plus the WACC raised to the second. Okay? And so we find that the present value of the two cash flows, $22,394,000 and $22,027,000. This is the present value of our free cash flow for 2006 and 2007. Then we're going to sell at the end of 2007. I'm 6. This is 5. This is 6. Yeah. And what are we going to sell it for? Well, we take our free cash flow here and divide it by our WACC minus the growth rate of 6%. And we get $500 million. This is our terminal value. Remember, we did this in chapter 8 in ManFin. So, we need to find the present value of this $500 million terminal value. And we're going to use the same discount rate as we used here, because it's in year 2. At the end of year 2, we're going to sell. and we find that the present value of the terminal value is 400 million. So, our three cash flows are 2 free cash flows and 1 terminal value. Add them up, and we get what's called the enterprise value of the firm, $445 million. Subtract out the long-term debt, and we get what's called the enterprise, this is the enterprise value. You subtract out the long-term debt, and we get what is called the equity value of the firm. Divide that by 30 million shares, and we get a price per share. So to summarize, using Lisa's approach, we take EBIT times 1 minus the tax rate, and we get NOPAT. We subtract out the amount the company spent on property, plant, and equipment, and we get free cash flow. We increase it 20% in 2005 and 10% in 2006. Then we find the present value of that using the WACC. Then we find the terminal value. So we increase our free cash flow by 6% and then divide that by WACC minus the 6%, okay, to get our terminal value. Then we find the present value of our terminal value, and we have our cash flows. That, present value of that, and that. Add these three things up. We get enterprise value, subtract out long-term debt, we get total equity value, divide by 30 million, we get $13 per share. All right, so that is question 1, and I will post that. I'll post this video, and then we'll move on to question 2. I'm sorry, that is those questions 1 and 2. We'll move on to questions 3 and 4 in the next video. All right, peace out, shalom.